Hello everybody and welcome to the Tortoise channel. In today's video is going to be on Microsoft and whether or not I believe this company stands as a good Tortoise type of investment at today's valuation levels. Okay, I'm actually looking forward to this video because Microsoft is one of the companies that has been on my watch lists for quite a while now. But I never really pulled the trigger on this company because they never really became that cheap by my standards. And if you guys have been following the channel for a while, then you know that I typically like to double money every 4 to 5 years, which means that I demand a 50, at least a minimum, right? My minimum acceptable rate of return is always around 15%. And so I have to be patient. And I have no problem with being patient because, as I've told you many times, these opportunities come every now and then. But when they come, you should be ready to load up the truck. And maybe that will be the case for Microsoft. Let's find out in today's video. All of us, I'm probably already well aware of Microsoft. Certainly, our viewers, because you have been avid readers and followers of the channel, then I think I covered Microsoft in the past, and so this shouldn't be news to you. But let's just cover the essentials right here, okay? And so as you can see, I have a Skool community as well, and in that Skool community, I shared a full deep dive on this company, right? So you can see right here in this deep dive goes back to January 2025, which means it was exactly a year ago that I posted a full investment case on the company, coupled with a one-pager covering all the essentials. And this is something that our members requested, and so I did that gladly. And even though a full year has already flown by, many of the things still apply. So I'm just going to give you a brief rundown of what I've created right here, okay? Microsoft needs no introduction. The software giant dominates multiple industries from cloud computing. Let me minimize this. From cloud computing to enterprise software and gaming. Business breakdown: Microsoft operates across 3 major segments: intelligent cloud, including Azure, GitHub, SQL Server, Enterprise Solutions, Productivity and Business Processes, right? Which includes Office, LinkedIn, and Dynamics. More personal computing, and this includes Windows, hardware, gaming, and search advertising. What about its incredible performance? Over the past few years, this company has delivered a staggering average annual return of about 26% per year, significantly outperforming the S&P 500's 11% return over the same time frame, give or take. Okay, so remember, this was posted on January 25th. Okay, to put that into perspective, a 10,000 investment in Microsoft 5 years ago would be worth around 31,000 today. Several future growth catalysts include cloud services, AI, gaming could double Microsoft's revenue by 2030, according to many analysts. But here is the catch, right? Valuation always matters, and at the time, Microsoft was trading at a whopping P of around 35 times, making it one of the most expensive stocks in the Magnificent Seven. Fortunately, today, that is not the case, and I know, judging by some of the comments that I read to other videos of mine, that you have bought Microsoft at a P of around 25 times. Look, the P only gives us a short, it's just another, he gives us a rough idea of the company's valuation, right? Because it's a relative measure that you can use to compare the company's valuations over the last 10 or 5 years. I like using the PE, all right? And it makes sense to use the PE for a company like Microsoft, because if I show you this right here, right, if we go here to Microsoft's financials, you can see, for example, their earnings. Where is the net income? Right here. If I show you the earnings of the company, you can look at the consistency of the earnings going back to 2010. And you can also see that from 2010 to 2018, they went nowhere. In fact, they went lower. But it was not until the end of 2018 that earnings actually started to exploding, right? Look where we are, trailing 12 months. They are going absolutely insane. Right? Look at this. This is on a quarterly basis. I mean, look at this massive jump, right? I mean, I don't know exactly why this happened in the last quarter, so I would have to do more due diligence. But it was a staggering jump, as you can see, right? So pretty cool, right? We like consistency and predictability in the numbers, and Microsoft definitely checks that box. Let's continue. Here, all right. So is Microsoft still a buy at these levels? In our latest report, we break down the company's competitive advantages, key risks, and valuation concerns. Whether Microsoft is still a good long-term investment. As usual, I'm sharing both our complete report and the one-pager. PS, later today, I'll record a short video highlighting the essentials. I love doing that stuff for the community. But you can see, look, this is the report. And as always, if you still want to learn a bit more about my investment process, go and watch our video on Constellation software that was posted on YouTube, posted to YouTube just a few days ago, and you can see that I provide a full insight into my investment process, and that includes answering to each and every single one of these answers. And the last question is, should we invest in the company? But this covers everything. The business model, which I break down, as you can see, whether or not management is capable. I'm looking at the track record of the CEO, whether do they have skin in the game. Also, I'm looking at the approval rating, right? Approval rating from the company's employees, which is very, very key as well, right? What employee reviews look like. All of these things are pieces of a puzzle that I'm trying to put together, and they will tell me whether or not I think the company has a place in my portfolio. And going through all of that, right? I only start creating one of these reports when the company already just checks off many of the boxes. I already know that it's a great company, right? The main problem might be the valuation, but that doesn't stop me from creating a full deep dive on a company and to add it to my watch list. And sure enough, you can see everything right here in great detail. And this is what I live for. I love this stuff. What are the main risks for the company? I detail every single thing. Does the company have a healthy balance sheet? I cover the most important ratios for my analysis, and so on and forth. So yeah, it's like that. And also, I share a one pager, and you can see we rebranded about a year ago. The company used to be called Like a Tortoise, All Human Investment. We rebranded since then to Like a Tortoise. That's why you see the All Human Investor icon right here. But look at that. This is the description, business model, and key revenue streams. Let me zoom in on this so you can have a much better. Why is this doing that? Okay, no, it's not working. So hopefully you can see something like that. But yeah, business model and key revenue streams, management, competitive advantage, main strengths, main risks. And then on the right-hand side, I provide a snapshot of the fundamentals, right? Historical growth, profitability, capital allocation, capital intensity, balance sheet, outlook, and valuation. At the time, it was around 35 times earnings. Today is around 25 times earnings, which is, I mean, a significant decline from those levels, okay? All right, so with that being said, let's talk about the company's fundamentals and whether I think this deserves a place in our portfolio. And let's start by looking at our platform right here, right? Stock analysis platform. You already know that I use stock analysis on a every time I'm doing a company deep dive. Not just deep dives, but I like using stock analysis and stock and lock as my preferred stock analysis platforms. All right. So you can see, look at that. The forward P is actually 22.86. Last time I checked this, it was around 45. So I can see the company continues to bleed, right? And it's now about 30% off its all-time highs. It's not every day that we see Microsoft at these levels, right? Down 30% from its highs. But you can see that analysts are still placing a strong buy rating on the company with an average price target of around 603, which implies a 50% upside from present levels. So needless to say, they are constructive on the company going forward. Right. Let's have a look at revenues. I mean, this company, look, Stock and Lock gives it a 4.18 out of 5 score. I mean, it really has been a phenomenal compounder. And I mean, the financials are just impeccable. Look at this, guys. From 2010 all the way to where we are right now, right on a trailing 12-month basis, you can see that total revenue has compounded by about 10.67% per year, right? This is so it meets our threshold of around 10% per year. That's typically what I want revenues to grow at, right? So we are definitely in that range. Good. Also, take a look at earnings. You can see that earnings have compounded faster, right, at about 12.42% per year. Very good. Something that I also like to see. In addition, I'm looking at, let's have a look at the diluted EPS. You can see that the diluted EPS has compounded at a faster rate, which means the company has been doing buybacks. And sure enough, if I show you the diluted shares outstanding, you can see that the company has decreased the share count by almost 13% since 2010. This is exactly what I want to see: growing revenues, consistency in profitability, right? Growing profitability and consistency in the numbers over time. I like all of that very much. Look at the operating income growing at 11.989% per year as well. Love seeing that. Okay. Now, let's have a look at margins. Now that we are on the income statement, margins, for those of you guys who are new to fundamental analysis, margins are always a percentage of revenue, right? So we want to see, ideally, I don't want to see stable margins. I want to see margins improving over time, right? Which means the business is becoming more efficient as well over time. That said, stable margins are preferable, right? I prefer stable margins to declining margins, and you can see that the let me do the yearly right here. Look at that. So the average gross margin going back to 2010 is around 69.61%. Awesome. With the latest at about 68. Look at the stability over time. Yes, there was a decline right here, but since 2015, look how stable gross margins have been. That's awesome, isn't it? Look at on the trailing 12-month basis, pretty cool. Let's check operating margins. Wow, look at this is amazing. And I was talking to a client the other day about this company. It's just incredible how these companies are just defying logic every single year. I mean, it's almost unheard of that if you look for a company the size of Microsoft, right? I mean, what is the market cap of this company? Let me have a look. They are about 3 trillion, right? And they are still managing to compound money at double digits per year. That is staggering. And if I show you the analysts' forecasts, if I go here to the statistics tab, you can see that analysts are projecting earnings per share growth of about 18.94% over the next 5 years. And look at revenue, guys, almost like 16.43% for the next 5 years. This is staggering for a company the size of Microsoft. Unbelievable. These companies are defying logic, as I put it. And look at that, right? So this is operating margin. You can see that there has been margin expansion from the lows we saw right here in 2016, which means the company is becoming more efficient. It's gaining operating leverage, right? It's able to spread its costs out to a larger customer base, gaining operating leverage over time. I love seeing that. Look at net margin. I mean, this is amazing. Look at that, right? It was a little bumpy, but again, look at this. Right now, it's sitting at about 39.4%. Guys, net margin overall 39%. These numbers do tell you, because Amazon has maintained this profitability for the better part of the last 10 years, right? In fact, for the better part of the last 16 years, it's hard to believe the company does not have a moat, right? When we see these kind of numbers and the consistency over time, look at that. So the average is about 28. Right now, we are sitting at about 39. It was a little bumpy, but if I just if I flip this to the yearly time frame, you can see, look, so the average is around 28. Right now, we are at 36. and it's actually improving. And for a company to do that over multiple years, it's definitely a sign of a strong moat. Okay, right. So let's also have a look at the free cash flow margin. I wouldn't read too much into this. This makes complete sense. It's declining, but you have to understand why this is happening. Again, the company is investing a ton of money in AI, right? They are investing a lot back into the business. Hopefully, that will unlock more profits down the line, but it depresses cash flows in the short to medium term. And that's why you see the free cash flow margin declining since a recent peak around 2022. All right. And so if I show you the cash flow right here, take a look at this. Look, it's awesome, right? Look, it's been exploding. But if I flip this to the quarterly, look at this decline. It's a sharp decline because the company, again, is investing a lot into data centers, and that is costing them money, right? But they need to remain competitive as well. In other companies, as you know, from Meta to Amazon to Google, have committed billions to capex. So why would Microsoft be an exception, right? Cool. So let's discuss now the balance sheet, which is important. Before we do that, let's continue and look at some of the debt measures here. Look at that. So the current ratio is at 1.39. Okay, so this is healthy. In addition, look at the debt to free cash flow, right? Look at that, under 3. 3 is our threshold. It means that ideally, I like the company to pay down all of its debt within 3 years of free cash flow, right? If it could, and that is certainly the case. So even with free cash flow depressed, the company, the company still has a very low debt to free cash flow. And look at the interest cover ratio. The higher, the better. How do you calculate the interest cover ratio? The operating income divided by net income, by the interest expense. It shows you how well the company can cover the payments on the debt, the interest payments on the debt from current operating income. The higher, the better, right? And we can see the company has no debt issues, which is great. And so we were about to discuss the balance sheet right now. Look at assets exploding, 14% compounded since 2014. Look at total cash, right? Right. So it's been declining exactly on the back of all the investments the company has been making. So understandably so. And then let's have a look at total liabilities going up as well, compounding at about the same rate as a slightly lower rate than the assets, which is good. So what this tells you as well is that book value is going up. Look at that. Book value, right? Total assets minus total liabilities. I look at the consistency over time. This creates a lot of predictability as well, which is something that I love. Needless to say, this company deserves to be trading at the premium. It has been a very predictable investment. Retained earnings, so also very consistently growing over time, which is something that we like to see. And okay, so what else can we see? Does the company have the company currently has a net they have a negative net cash position, right? Total cash and cash equivalents have been depleted exactly because of the investments. And so with total debt sitting at 123 billion, then this means they have a net cash position. But remember, the free cash flows that the company generates allow the company to cover all of that debt if they wanted to. All the investments into capex are a decision of the company, right? It's not that they have to invest. I mean, they could cut spending at risk of becoming less competitive in the years ahead. So that is optional, and the debt levels are well controlled, well managed by the company. All right. I mean, look at that. That's awesome. Cool. We already discussed margins, right? What else do I want to share with you here? Look at that. The shareholder yield sits at 1%. The reason for that is because the buyback yield is very low, and so is the dividend yield. So, I mean, looking at the shareholder yield, it's not really interesting, right? Shareholder yield 1.03%. What does that mean? In my opinion, means that you can find better investments in the market, right? Purely from a shareholder yield standpoint. Typically, people like to compare the shareholder yield to safer investments like bonds. Um, with the caveat that bonds won't grow, right? They only pay you a fixed interest rate, and you don't have any. But that's it, right? You will always collect your 3 point ish percent every year, but you know exactly what you're going to get with Microsoft. The company can continue to grow over time and deliver a lot of returns in the form of growing dividends, but also share price appreciation. But that said, this is not. This is still very. This is very low. All right. Cool. So let's have a look here. Let me check something else on the income statement. I want to see. So the diluted shares outstanding have been declining steadily. In addition, we can see that the company was doing buybacks as the stock was very expensive, right? So, for example, that post that I covered is from 2025, January 25, and you can see that the company was still committing billions of dollars towards capex. So let's have a look at our cash flow. Net common stock issued. Yeah, take a look at this. So in 2022, now granted they did less, but still, what was the valuation of the company in 2022? Let's find out. In 2022, let's go to financials. What was the P of the company back then? The P ratio in 2022 was around, was around 26.41. It wasn't egregious, right? It was not egregious, but it was still high. But this is something that we see across American businesses. These guys, it's just a corporate thing that I hate. They just do buybacks even with stocks at high valuation levels. Um, Anyway, it's not nice to see, right? I like companies to do that when the stock is depressed, but that's not really common for a company like Microsoft. That said, I don't like that, and so yeah, just keep that in the back of your mind. And awesome. So discussing now cash flows right here. Cash from operating activities going up very well. Consistency is amazing once again, 12.24%. Stock-based compensation, I don't like to see this going up as well. And it is going up, compounding at about 13% per year. Sure enough, if I go here to the metrics, let's have a look at the percentage. It's not so much that share-based compensation is going up. We need to see how we need to see the relation, right? Or the relationship, or we have to see how stock-based compensation relates to revenue and operating cash flows. If it's a big percentage, then that's a red flag. Let's find out. Not yeah. So look, not really. Share-based compensation as a percentage of operating cash flow. Look, right now, take a look at this. It's been stable since 2010, and it's not egregious. Ideally, I like to see this under 10. It's definitely under 10, right? So yes, pretty cool. What about share-based compensation as a percentage of revenue? Look at that. Only 4.25% on a yearly basis. Do I like that? I love it. Okay. This is exactly what you want to see. Nothing to complain about there. Free cash flow, we already showed you this. And look at the investments in plants, property, equipment. That's CapEx. Look at this. Oh my God. Look how much money these companies have been spending, have been allocating toward CapEx, right, since 2021. Look at this. Unbelievable. Absolutely incredible. It remains to be seen whether these investments will become profitable, will translate into profits down the line. I think a lot. Look, it's hard to imagine that a lot of this won't be translating into profits, but whether they will still get a good return on their investment, that is what I don't know. Okay, this is a lot of money, so it's just incredible. But cool. And what else do I want to share? Analysts, as I mentioned, are constructive on the company. They are expecting the stock to grow almost at 20%, excuse me, the earnings per share to grow at almost 20% in the next 5 years, which is good. Let's have a look at the insider ownership of the company. Show only company executives. You can see that this guy, Charles Schwab, is the independent director, about $20 billion worth of stock. You can see that the CEO holds about $360 million worth of stock. So we are talking about a lot of skin, an owner operator. I mean, we are talking about the company with high insider ownership, right? And it's nice to see that the CEO has been at the helm of the company for so many years. You know, look at the president and vice chair, 161 million. So we have a lot of high insider ownership, which is something that I like to see. But let's have a look at the insider transactions. Have they been buying or selling shares in the company? Come on, it's a bit slow, so bear with me. Oh, wait. Okay, cool. Right here. Nice. So let's see. I see selling. Ooh, I see far more selling than buying. Yeah, exactly. Look at that. This company executive, I see a lot of selling right here. I don't see any buying so far. I see a lot of selling. Yeah, look at that. These are all grants, so I see a ton of selling happening. Look at this. I mean, there are many. Remember, there are many reasons why insiders would sell, but only one reason they will be buying is because they think the stock is going to go up. So, what does that mean? It's not ideal. It may signal that they actually think the stock is overpriced, right? And that's why they are still buying. But look at that. They were doing selling. The last selling activity happened in January 2026. We are already in February the 16th. But yeah, so something to keep as well in your mind. And there's nothing really to say. Let's have a look at our sheet right here. For those of you guys who are new to the channel, remember that I put everything in a just to avoid going back and forth, right? Just to avoid juggling different tools. I like to put all the metrics together, the ones that I like to pay attention to, and so I combine everything in a sheet. And you can see that on the left hand side you have the most important variables from the financial statements: balance sheet, income statement, and cash flow statement. On the right hand side, then you have the margins, the profitability and value creation metrics, right? The valuation ratios, the capital intensity. So let's delve deeper into each of them so you guys can see what else we should pay attention to. Right, so on a P, we already discussed that. Look at that, the P is around 25. The price to free cash flow is very high, again, because free cash flow is depressed, right? So don't pay too much attention to that because of the heavy investments in capex. That's it. So free cash flow yield is low. Let's have a look at the returns. We have to look at the returns as well, right? Look at that. The return on equity. ROI sits at about 28%, which is fantastic, well above our ideal 15% threshold. Same thing for return on assets, attractive. Same thing for ROIs. And now let's have a look at the evolution of that capital allocation efficiency over time. And for that, I go here to metrics. I'm using trailing 12 months. Yeah, let's see what we have right here. So, return on equity. Look at that. It's actually coming down. And this makes a lot of sense because, remember, it makes sense because the company. So, it makes sense because the company so the cash position of the company declined substantially, right? And how do you calculate the return on equity? You have to do shareholder equity, right? So you have to do the net income, as you can see right here, divided by shareholder equity. And so the net income is growing, which is good, but the shareholder equity is actually it's actually going up because of the debt the company has taken on as well. But the main reason for this is because of all the investments, right? So all the investments the company has been doing, this is causing the returns on capital to face downward pressure. And the same thing should probably happen exactly. Look at that, right? Since a high point right here in 2022, it's been coming down. And look, guys, the reality is that we don't know when the returns on capital are going to go back up, exactly because these companies are spending a ton of money again on AI related projects, and that is costing them profitability right in the short term, which is why we're seeing declining returns on capital. Right? It's not ideal, but because we understand the business, then we can say that with confidence. Okay, so let's go back here to my sheet. Just wanted to show you that those returns going back many years. What am I doing? Not this. This is the sheet. Okay. What about capex? Look, I always like to try to understand the capital intensity of the company, and you can see how these companies that were once capital light businesses are now boasting very high capex levels as a percentage of sales and operational cash flow. Look at that, 10% of sales, 20% of operational cash flow. I mean, yeah, ideally, I want to see capex as in relation to sales below 5%, and capex relative to operational cash flow under 15%. We are well above those thresholds right now, right? And remember, capex includes both maintenance capex and growth capex. So the capex that I used here is not total capex; is actually maintenance capex only. So if I go here, if I go to financials, let me show you this. Let's go here to financials. Let's go to cash flow statement, trailing 12 months. And look at that. So this is total capex, about 83 billion. What we want is depreciation and amortization, which typically can be used as a proxy for capex. And that is the number that I use right here, as you can see, right? And even though after I made these adjustments, you still are left with these very high percentages of capex relative to both sales and operational cash flow. It's what it is. From a debt standpoint, the company is very healthy, as we already discussed. So now let's talk about valuation, whether I think this company is a great buy at current prices. For this company, let's use some of our valuation methods, namely Phil Town's 3 valuation methods, and I will tell you why I prefer the margin of safety calculation method versus the other 2. Remember, I've said it many times, the margin of safety is best suited for companies that are growing rapidly. Okay? If the company is growing at 3, 4, even 6%, the margin of safety is not adequate because it will give you a very low margin of safety entry price. But for Microsoft, we already know that analysts are projecting about 18% earnings per share growth over the next 5 years. So I'm going to use 15% as my growth assumptions, right? I want to be conservative here. Instead of projecting 18%, I will be using 15%. Go back to my previous videos if you want to gain a better understanding of how these methods work. So we start with current earnings, right? You can see that Microsoft's current earnings per share are about 15.98, that you can see right there. Then I'm going to grow that 15.98 at 15% per year over the next 10 years because that's my projected growth rate, right? What's the PE that I will assign to the company 10 years time? I will do 50 twice the growth rate. So if I'm projecting 15% growth, then the PE is about 30, and you can see that the historical PE over the last 10 years is about 32. I will use the most conservative one, right? If you grow 15.98 at 15% per year over 10 years, that gives you an estimated future earnings per share of about $64 per share, right? And then if you multiply that by the PE of 30 that you are assigning to it, that gives you a future value per share, so a future stock price of around 1,939.50. This is the future value of the company in 10 years, provided our assumptions are correct. But we have to discount that back to the present, right? To determine the company's intrinsic value today. And so, because I always want 15% on my money, you can just divide that by 4, because in 10 years you will get two doubles, right? So you divide this by 4 and you get intrinsic value of 484, and then you never pay intrinsic value. So you can see that what this tells you guys is that the company's intrinsic value today is around $484 a share, and the stock price is currently at 400, so it's trading below our conservative assumptions, which is very good to see. But you never pay fair value, right? That is the purpose. We want to buy with a big margin of safety, and I'm going to take 50% of this. And so 484 divided by 2, that gives you a most price, right? Margin of safety price of around 242. And this is the price that I will be paying for each share today. And if I go here to our eToro platform, and for those of you who are new, I only use eToro for educational purposes, but I use interactive brokers to execute all of the company's transactions. And sure enough, 252 is the line that is marked right here on the chart. Will Microsoft ever crash 55% from its all-time highs? It will be hard to happen, but guess what? If a lot of the investments don't actually turn into profits in the next month or in the next year or so, investors will start asking more questions, and this may very well get the stock down to those levels, and then I will consider an investment, provided the thesis has not changed. That's what we do: rinse and repeat, and this is what will allow us to outperform over time. Okay, right. So let's continue. Right, taking a sip right here. Slow. Here we go. It seems we are back. And then look at that. I used payback time as well in the 10 cap rate. And you can see that the results that we get are very similar, right? Because let's discuss. So why do I think payback time is not adequate for Microsoft? Because the free cash flows are depressed because of all the investments the company is doing. And so if you compare the net income of the company at around 119 billion, look how that contrasts with trailing 12 months free cash flows of 77 billion. Okay? So, I mean, if you calculate the intrinsic value using free cash flow, of course, the margin of safety entry price is going to be much lower. And that's why I get here 163. And using the 10 cap rate, which starts with operating cash flow, total capex is quite high. Okay, and that's why you get the owner earnings of around 173. So I don't think for the case of Microsoft, the 10 cap and the payback time are adequate. But look what happens if I use earnings per share, right, instead of free cash flow. So in that case, the payback time is going to be 252. So you can see that the payback time from earnings per share is quite similar to the margin of safety price number that we get of around 242. Okay, so this is definitely the price that I would be willing to pay for Amazon, for Microsoft shares, right? Look at, last but not least, let's do a simple DCF calculation right here for you guys to see using net income. Let's project 15% growth of that income over 10 years. And now let's do this. Look at that. So we add the cash and cash equivalents, we subtract total debt, and when we divide the equity value by the number of outstanding shares, we get the DCF price per share of about 253, also in line with our estimates right here, right? Exactly what we want to see. Fantastic. So that is definitely the price I will be willing to pay. Okay, what does that mean? If I go here to stock analysis platform and look, so the average price target is around $603 a share, right? That is the average price targets. Let's see, forecasts. Yeah, look, $603 a share, according to analysts. What does this mean right here? Remember, each of these valuation methods have a 50% margin of safety built in. So if I'm willing to pay $250 a share, yeah, according to the margin of safety price, that means the intrinsic value of each share is 484. What we see right here, right? And if I use, for example, the free cash flow, if you use the free cash flow per share, which is erroneous given what I explained, but then the intrinsic value is 163 multiplied by 2. Okay, so per my understanding, because I will be buying at around 250, the intrinsic value per share sits at around $500 a share. Okay, again, this signals a potential undervaluation at present levels, and so I agree with analysts in that front, and I understand why they have the company, they rate the company as a strong buy. All right, this is it, guys. So will I buy Microsoft at these levels? The answer is no. I would wait for the price to come back down to around 252. If that happens, please send me a message, because I'll be interested in doing a reassessment of the investment, and provided the thesis, right, provided the story remains compelling, then I would gladly start a position around those levels, and that's it. So with that said, guys, smash the like button if you found this valuable, and because that will definitely help the channel grow going forward, and this will definitely incentivize us to continue to put out as much value as we possibly can, and we are all in the same journey towards financial freedom, and let's be the tortoise instead of a hare, and yeah, let's play this game together. Cheers, guys. Thank you so much. Stay tuned for more.